Imagine this. Jason, a welder from Detroit, proudly drove home a brand new Ford F-250 last year. He paid $64,000 for it. A huge commitment, but one he believed was worthwhile. A few months later, as he passed the same dealership where he bought it, he noticed the exact same truck, same trim, same year, same features, sitting on the lot. But the price tag had changed dramatically. It was now listed at $51,000. Overnight, Jason's truck had lost $13,000 in value. That's not just depreciation, it's financial devastation. Jason's story isn't unique. Across America, millions of car owners are about to discover that their vehicles are worth far less than what they owe on them. And for those looking to buy, the timing couldn't be more critical. We are standing on the edge of what industry insiders are calling a used car apocalypse, a collapse in vehicle values so steep and so sudden that it will reshape the entire automotive industry. Real quick, if you're into videos that cut through the noise and break things down clearly, go ahead and hit that like button. It helps more people find this, and if you're not subscribed yet, now's a good time. We've got more deep dives coming your way. Also, drop a comment and let me know what you think. I'd love to hear your take. Now onto the video. To understand why this collapse is coming, we need to look at the forces that inflated used car prices in the first place. Over the last 3 years, the market has been unlike anything we've seen before. Vehicles, traditionally known as depreciating assets, suddenly became investments. Families who bought SUVs and trucks discovered, shockingly, that their cars weren't losing value. They were gaining it. Dealers were calling customers begging to buy back vehicles for more than their original purchase price. Payments soared to record levels, and yet demand stayed red hot. But every bubble eventually bursts. Today, the conditions that created this bizarre surge in car values have reversed. Supply chains that once strangled new car production are flowing again. Interest rates, which made cheap loans accessible, have spiked to multi-decade highs. Rental car companies that once hoarded vehicles are now dumping them by the millions. Add in repossessions, expiring leases, and a flood of flood-damaged vehicles re-entering circulation. And you have the recipe for a historic crash. This isn't just about the price of used cars dipping by a few $1,000s. Analysts warn that values could plunge 20–30% by the end of 2025, with some categories, luxury SUVs and heavy-duty trucks, potentially losing 40% or more. On a $70,000 vehicle, that's a loss of nearly $30,000 in just 2 years. And the consequences go far beyond car buyers and sellers. Dealerships, banks, insurance companies, and even local governments are bracing for impact. This isn't just a car problem. It's a financial problem. It's a consumer confidence problem. It's a problem that could ripple across the economy in ways few people expect. So as millions of Americans head into 2025, unaware of what's coming, the question is simple. Will you be among those caught in the collapse? Or will you be one of the few who turn it into the opportunity of a lifetime? For as long as cars have existed, one rule has held true. They lose value the moment you drive them off the lot. Depreciation was as certain as the sun rising. But then, in 2020, something extraordinary happened. Cars started appreciating. Take the 2020 Ram 1500. In 2019, it was a $35,000 truck. A year later, amid the chaos of the pandemic, that same truck was commanding nearly $48,000. A Toyota Camry, one of the most common sedans in America, began climbing in value instead of dropping. Used cars suddenly became like fine art or real estate, assets that could grow in worth simply by sitting in your driveway. Why did this happen? The answer lies in 3 fragile pillars that held up the automotive market during the pandemic. First, supply chain chaos. With factories shuttered and semiconductor shortages crippling production, automakers simply couldn't build enough new vehicles. Buyers who would have purchased new cars turned to the used market, creating unprecedented demand. Second, artificially low interest rates. To keep the economy afloat, the Federal Reserve slashed rates to near zero. This cheap money flowed into the auto market. Buyers who might once have balked at high monthly payments suddenly found loans accessible. Borrowing $40,000 or even $60,000 for a used vehicle no longer seemed outrageous when interest rates were so low. Third, rental car companies froze fleet sales. Typically, giants like Hertz and Avis rotate out millions of vehicles every year, keeping supply steady in the used market. But during the pandemic, they couldn't get replacements, so they held onto their cars. That decision removed millions of vehicles from circulation, squeezing supply further. With these three forces converging, the result was chaos. Between 2020 and 2022, the average monthly payment for a used car skyrocketed to $730, an astonishing figure. That's not just a car payment. In some parts of the country, that's a mortgage, yet people paid it because they felt they had no choice. Vehicles weren't just tools of transportation, they became scarce commodities. But here's the problem with bubbles. They're unsustainable. And once the underlying forces reverse, the fall is often just as sharp as the rise. Fast forward to 2023 and 2024. Supply chains have largely recovered. New vehicle production is ramping up. Rental car companies are dumping their aging fleets all at once. And most significantly, interest rates have spiked. Loans that once seemed manageable are now crushing burdens. The three pillars that held up the used car bubble are crumbling simultaneously. What remains is an overinflated market poised to collapse under its own weight. This isn't a normal correction. This is the bursting of a bubble that should never have existed in the first place. And for millions of car owners, especially those who bought at the peak, the consequences will be devastating. Most people assume that dealerships own the cars parked on their lots. But in reality, that's almost never the case. The vast majority of dealerships rely on something called floor plan financing. It's essentially a giant credit line provided by banks or manufacturers that allows dealers to stock their lots with vehicles. Here's how it works. Every car on the lot accrues interest, about $30 per day per vehicle. For a dealership with 100 cars, that's $3,000 a day just in carrying costs. When cars were selling quickly and values were rising, this system worked seamlessly. Dealers moved inventory fast, paid off the loans, and pocketed the profits. But now, the model is collapsing. Cars are sitting unsold for 60, 90, even 120 days. Each day, the costs pile up, eating into already thin profit margins. Dealers can try to hold out for better prices, but the longer they wait, the more they bleed cash. And it gets worse. When car values decline, banks that provide the financing get nervous. They send auditors to inspect dealer lots and recalculate the value of the vehicles. If a dealer owes $40,000 on a car that's now worth only $35,000, the bank demands the dealer make up the $5,000 difference immediately. These demands are called margin calls, and they're hitting dealerships across the country right now. One dealer in Wisconsin explained the problem bluntly. "I've got vehicles that have been sitting for over 90 days. That's almost $3,000 in floor plan costs per vehicle. I have to sell them, even at a loss, just to stop the bleeding." The pressure is relentless. Some dealers simply can't meet the margin calls. A handful have already surrendered their businesses, literally handing the keys to the bank. To insiders, this all feels eerily familiar. In 2008, the housing market collapsed because homeowners couldn't pay their mortgages once values fell. Today, it's not homeowners, it's dealers. They are drowning in debt tied to depreciating assets. The parallels are unsettling. Just as the housing crash cascaded through the broader economy, the collapse of dealerships could ripple outward. When dealers go under, local communities lose jobs, tax revenue falls, and consumers lose service centres and trade-in options. This is why the used car apocalypse isn't just about falling prices. It's about an entire industry facing a structural breakdown. Dealers aren't just middlemen in this story. They're the first domino to fall. Every single day in the United States, 15,000 vehicles are repossessed. Let that number sink in. By the time you finish this video, hundreds more cars will have been taken back by lenders. By the time you go to bed tonight, more than 15,000 Americans will have lost their cars. And this isn't a one-time spike. It's the daily reality of an industry under severe strain. Behind each statistic is a real person. Tom, an oil field worker in Oklahoma, lost his job when energy prices fell. He tried to keep up with his $700 monthly payment on a Silverado, but eventually he couldn't. One morning, the truck was gone. A single mother in Florida faced an impossible choice: pay her rent or make her SUV payment. She chose to keep a roof over her children's heads. The bank took the car. These stories are happening everywhere, and each repossessed vehicle ends up in the same place: auction lots, where lenders dump them as quickly as possible to recover at least part of the loan. But here's the problem. Auctions are already overflowing with supply. The more repossessions pile up, the faster prices fall. It's a vicious cycle that feeds on itself, and repossessions are only the first wave. A second, even bigger wave is about to hit: the return of leased vehicles. During the pandemic, leasing was incredibly popular. Millions of Americans locked in 3-year leases on cars in 2020 and 2021, often at inflated values. Those leases are now expiring all at once. Banks and leasing companies expected to resell those vehicles at strong prices. They built their financial models on the assumption that used cars would retain much of their value. But that's not what's happening. One banker in Chicago admitted, "We're looking at a 30% gap between what we projected these vehicles would be worth and what they'll actually sell for at auction. That's billions of dollars in losses. Those losses won't be absorbed quietly. Banks will pass them on to consumers in the form of tighter lending standards, higher interest rates, and reduced access to credit. In other words, everyday buyers will pay the price for the industry's miscalculations. Repos and lease returns together form a tsunami of supply that the market cannot absorb. Every repossessed vehicle adds downward pressure. Every leased vehicle returned at a loss makes banks more cautious, which in turn makes it harder for the next buyer to get a loan. This isn't just a wave, it's a flood. And when that flood hits full force, car values won't just decline, they'll collapse. As if repossessions and lease returns weren't enough, there's another tidal wave of vehicles about to hit the market: rental fleets. Companies like Hertz, Avis, and Enterprise typically sell about 2 million vehicles per year as they refresh their fleets. During the pandemic, they stopped. With no new cars to buy, they held onto their vehicles longer than ever before. That decision artificially suppressed supply in the used car market, pushing prices higher. But now, the opposite is happening. These companies are finally dumping their aging fleets all at once. Wholesale auctions, already drowning in repossessed vehicles, are being flooded with rental cars too. It's not a trickle anymore, a Texas auction manager admitted. It's a flood, and we don't have enough buyers to absorb it all. The sudden surge in supply alone would be devastating. But there's a darker, hidden danger lurking in the shadows of the used car market: flood-damaged vehicles, often referred to as zombie cars. In the last 2 years, the United States has endured multiple catastrophic floods and hurricanes. Hurricane Ian alone damaged an estimated 40,000 vehicles in Florida. Floods in Kentucky, Missouri, and California added tens of thousands more. Many of these vehicles were declared total losses and scrapped. But not all. According to Carfax, more than 45,000 flood-damaged vehicles have been title washed, meaning they were given clean titles in certain states despite being unsafe. These cars are now circulating through the used car market, often disguised as normal, well-kept vehicles. Frank, a used car inspector in Georgia, explained how it works. They dry them out, replace the carpets, clean the electronics, spray everything with deodorizer. To the average buyer, they look perfectly fine. 6 months later, the electrical system fails, mold grows in the ducts, and the brakes corrode from the inside. The presence of these zombie cars makes an already dangerous market even riskier. Buyers desperate for bargains may unknowingly purchase vehicles that are not only financial disasters, but also safety hazards. And dealers, under immense financial pressure, are increasingly willing to look the other way. Frank admitted, "I've seen dealers buy cars at auction they would have rejected 2 years ago. They need inventory at specific price points, and they're willing to overlook red flags. The combination is lethal. Legitimate vehicles are plunging in value, while compromised vehicles are being disguised and sold. Consumers are left to navigate a minefield where the risk of financial loss and physical danger grows every day. This is why analysts warn that the used car crisis isn't just about money, it's about safety. When tens of thousands of flood-damaged vehicles are mixed into a collapsing market, everyone loses." The collapse of used car values doesn't stop at dealership lots or auction houses. It spreads outward like falling dominoes, threatening entire industries and local economies. Analysts are already predicting 20–30% declines in used car values by the end of 2025. On a $30,000 car, that's a $6,000, $9,000 loss. But insiders warn those estimates may actually be too conservative. A veteran dealer described it bluntly. "This isn't a correction, it's a bloodbath. I've been in this business 22 years, and I've never seen inventory levels like what's coming." For dealerships, the stakes couldn't be higher. Nearly 40% of new car dealers rely on used vehicle profits to stay afloat. When those profits disappear, so will the dealerships. Experts predict up to 20% of dealerships could close in the next 18 months. That's not just a business issue, it's a community issue. Fewer dealerships mean fewer places for consumers to buy or service vehicles. It means job losses for mechanics, salespeople, and administrative staff. It means less tax revenue for local governments, many of which rely heavily on vehicle sales to fund schools, infrastructure, and services. Banks aren't safe either. Auto loans make up a significant portion of consumer debt portfolios. When values collapse, defaults rise. Repossessed vehicles are worth less than the outstanding loans, leaving banks to absorb the losses. Insurance companies face a similar problem. When cars are totaled in accidents, insurers base payouts on market values. As values plunge, policyholders receive less, sparking frustration and disputes. Even Wall Street is watching nervously. Auto loan-backed securities, financial instruments tied to car loans, are widely held by investors. If defaults rise sharply, the ripple effects could hit portfolios far beyond the automotive sector. Some analysts have already compared the situation to the subprime mortgage crisis, warning that auto loans could be the next weak link in the financial chain. The domino effect doesn't stop there. Local governments tied to auto sales tax revenue will face shortfalls. States like Texas, Florida, and California, where vehicle sales generate billions in tax dollars annually, could see budget gaps widen. In short, the collapse of the used car market isn't an isolated event. It's a contagion that spreads across dealerships, banks, insurers, governments, and investors. And the scariest part? Most Americans have no idea it's coming. If there's one thing that powers the American auto market, it's not steel, gasoline, or even technology. It's credit. More than 85% of new vehicles and nearly 60% of used vehicles are purchased with financing. Without loans, the entire industry grinds to a halt. And right now, those loans are drying up. Banks see the storm forming and they're retreating fast. Lending standards have tightened dramatically in just the last year. Minimum credit score requirements have jumped by as much as 50 points. Down payment demands have doubled, and interest rates have risen to levels not seen in more than a decade. Consider the story of Daniel, an accountant in North Carolina with a 770 credit score. Just a year ago, his friend bought a 3-year-old BMW with only 5% down and an interest rate of 3.5%. But when Daniel applied for the same model, he was stunned. The bank required a 20% down payment and offered him a 6.9% rate. Despite his excellent credit, he was treated like a risky borrower. This isn't an isolated incident. It's the new reality. Loan officers admit they're under pressure to protect banks from what they see as inevitable losses. Rebecca, a loan officer in Texas, explained, "We know vehicle values are going to drop significantly. If we loan $30,000 on a car that's worth $25,000 in 6 months and the buyer defaults, we're stuck with the loss." The result is a vicious cycle. Tighter lending means fewer people qualify for car loans. Fewer buyers means more vehicles sitting unsold on lots. Dealers, desperate to move inventory, slash prices. Lower prices push more borrowers underwater on existing loans, which leads to more defaults. Those defaults spook banks into tightening credit even further. It's a downward spiral with no clear bottom, and the impact isn't limited to subprime borrowers. Even consumers with prime or super prime credit scores are feeling the squeeze. Banks aren't just raising rates, they're scrutinizing income verification, job stability, and debt-to-income ratios more aggressively than ever before. For many Americans, qualifying for a car loan in 2025 feels more like applying for a mortgage. This financing freeze is perhaps the most dangerous part of the used car apocalypse. Because without credit, demand doesn't just slow, it collapses. A market that depends on financed purchases cannot function when banks close the spigot. If you thought repossessions and falling prices were bad, consider this. What happens when millions of Americans want to buy but can't get approved for loans? The answer is simple. The market doesn't bend. It breaks. For decades, the ability to trade in your old car has been a cornerstone of American car ownership. That trade-in value often serves as the down payment for your next vehicle. But what happens when that trade-in isn't worth enough to cover the loan still attached to it? That's the trap millions of Americans are falling into right now. Take James, a construction foreman from Arizona. In 2021, he purchased a Toyota Tundra for $56,000. When he recently tried to trade it in for a newer model, the dealer offered him just $38,000. The problem? James still owed $45,000 on his loan. The dealer suggested rolling the $7,000 in negative equity into a new loan. That would have pushed James's monthly payment to over $900, a figure he simply couldn't afford. James walked away, but many others don't have that option. They roll the negative equity into new loans, creating an even larger burden. It's like trying to dig out of a hole by digging deeper. Industry data shows that nearly 40% of car owners with loans are now underwater, owing more than their cars are worth, and that percentage is rising as used car values continue to fall. For these owners, the trade-in trap is real and dangerous. Here's why it matters. When consumers can't trade in their vehicles, they stop buying new ones. That slowdown ripples through the entire auto market. New car sales decline, dealers lose revenue, manufacturers struggle with unsold inventory, and the cycle of devaluation accelerates. Worse still, being underwater puts owners in a precarious financial position. If they face a job loss, medical emergency, or other unexpected expense, they can't simply sell the car to get out from under the loan. They owe more than the car is worth. Their only option may be voluntary surrender or repossession, which adds yet more supply to an already saturated market. This trade-in trap is especially brutal because it hits ordinary families hardest. Wealthier buyers can absorb losses or pay off loans early, but middle and working-class Americans, those who rely on financing to make ends meet, are stuck. They're trapped in cars they can't afford to keep, but also can't afford to sell. In past downturns, consumers could count on their cars as a form of equity, a bridge to their next purchase. In this collapse, that bridge has burned, and without it, millions of Americans are stranded on the wrong side of the financial divide. If you think automakers are just innocent bystanders in this unfolding crisis, think again. They are both contributors to the problem and potential victims of its consequences. During the pandemic, production slowed to a crawl. Automakers missed out on billions in potential revenue, so when supply chains recovered, they overcompensated. Factories roared back to life, churning out trucks, SUVs, and crossovers at record pace. Manufacturers wanted to make up for lost time and lost profits. But in their eagerness, they overshot. Lots are swelling with unsold vehicles, many of them high-margin models that consumers are no longer eager to buy. A senior executive at one of the big three automakers admitted anonymously, "We saw the profit margins dealers were making during the shortage and wanted our piece of that pie. So we ramped up production aggressively. The result? Too much inventory at exactly the wrong time." This creates a dangerous dilemma. Automakers can cut production, but that raises costs per vehicle and hurts efficiency. Or they can slash prices and offer steep incentives, which undercuts used car values even further and angers customers who bought at higher prices. Either choice damages the brand. And then there's the looming issue of electric vehicles. Automakers have invested billions into EV development, betting their futures on the transition away from gasoline. But with used car prices collapsing and gas prices stabilising, the financial case for EVs is weakening. Consumers are asking, why pay more for an electric car when a nearly new gasoline model can be had for 30–40% off? Manufacturers are already rethinking their ambitious EV timelines. Some are delaying new model launches, others are scaling back production targets. The ripple effects are massive. Battery makers, semiconductor suppliers, and engineering firms tied to EV development could all face cutbacks. And the fallout won't just hit factories, it will hit jobs across the entire industry. Designers, marketers, salespeople, engineers. A collapse in the used market doesn't just threaten today's profits, it threatens the entire trajectory of the automotive future. The irony is stark. Automakers helped fuel the bubble by overproducing and chasing short-term gains. Now, they may be forced to pull back on the very innovations, like EVs, that were supposed to secure their long-term survival. In short, the used car apocalypse isn't just a consumer crisis. It's a manufacturing meltdown with consequences that could reshape the industry for decades to come. When we talk about a market collapse, it's easy to imagine that every car will simply lose the same amount of value across the board. But the truth is more complicated. Different categories of vehicles will be hit in very different ways, and those differences could mean the gap between saving thousands or losing them. Hardest hit: luxury SUVs and full-size trucks. Vehicles like the Cadillac Escalade BMW X7, Mercedes GLS, GMC Yukon Denali, and Ford F-250 Limited are poised for the steepest drops. Why? They combine three fatal flaws in today's market: high original prices, poor fuel economy, and expensive maintenance costs. With interest rates rising and consumer budgets tightening, fewer people can justify dropping $80,000, $100,000 on a luxury SUV. Auction reports already show $50,000 declines on two-year-old Escalades. A vehicle that sold new for $110,000 might struggle to fetch $60,000 at wholesale by early 2020. Moderate declines: mid-size SUVs and trucks. These vehicles, Toyota Highlanders, Honda Pilots, Ford Edges, Chevy Colorados, sit at the heart of the American market. Families rely on them, and demand won't evaporate entirely. Still, oversupply will drag values down by 20 to 25%. For example, a $35,000 Highlander could shed nearly $9,000 in value in the next year. Painful, but not catastrophic compared to luxury models. Most resilient, compact cars and hybrids. Here lies the silver lining. Affordable, fuel-efficient vehicles like the Honda Civic, Toyota Corolla, Hyundai Elantra, and Toyota Prius will fare better. Why? Because they check two critical boxes: low purchase prices and cheap operating costs. In a downturn, people gravitate toward vehicles they can afford to own and maintain. Analysts expect compact cars and hybrids to drop only 12 to 15%, not immune, but relatively safer than the rest. For owners, these differences could be devastating. Imagine buying a luxury SUV in 2022 for six figures, only to find out 2 years later it's worth half that. For buyers, the collapse presents opportunities. A 2-year-old Escalade at $60,000 might look like an incredible bargain if you can stomach the gas and maintenance bills. This divergence also reshapes consumer behaviour. Some owners of large SUVs and trucks are already downsizing, selling now, even at a loss, and moving into a compact or hybrid may actually save them thousands in avoided depreciation. What's clear is this: not all vehicles are created equal in a collapse. Understanding these differences could mean the difference between financial survival and financial ruin. The used car apocalypse will create winners and losers, not just among people, but among vehicle categories themselves. The used car collapse isn't hitting the country equally. Where you live and what your credit score looks like will shape your experience in this downturn more than you might think. Urban centres, first and hardest hit. Cities like New York, Los Angeles, Chicago, and Atlanta are ground zero. Why? These areas have the highest concentration of leased vehicles, rental car operations, and dealerships. They also have alternatives: ride-sharing, public transit, shorter commutes that allow residents to delay car purchases. With dealers desperate to move swelling inventories, competition is fierce. Prices are already dropping fastest in cities where auctions and lots are oversaturated. One Los Angeles dealer put it bluntly: "It's a race to the bottom. Everyone is cutting prices, and no one can afford not to." Rural areas, delayed but brutal impact. At first glance, smaller towns and rural regions seem insulated. Cars are necessities, not luxuries. There are fewer transportation alternatives, but analysts warn this protection is temporary. The collapse will hit rural areas with a 3 to 6 month delay, says transportation economist Dr. Sarah Chin. When it arrives, it may actually be worse because local economies are less diverse and more vulnerable to shocks. That means rural dealers, already operating on thinner margins, could vanish quickly once values fall. The credit score divide. Then there's the financing gap. For borrowers with excellent credit, scores above 720, the downturn could actually create incredible opportunities. Dealers desperate to unload inventory will offer unprecedented deals: extended warranties, interest rate buy-downs, even 0% financing on used vehicles. James, a retired banker with a 780 credit score, recently bought a 3-year-old Lexus ES for $28,000, $12,000 below last year's price. The dealer threw in a 5-year warranty and free maintenance just to close the deal. For subprime borrowers, however, the story is grim. Interest rates for those with scores under 650 are climbing above 20%. Down payments are soaring. Some lenders are refusing to finance certain categories of vehicles altogether. Melissa, a healthcare worker in Missouri with a 620 credit score, explained, "Last year, I could have gotten approved with $1,000 down. Now they want $6,000 and the rate is 21%. There's no way I can afford that." The result? Wealthy and financially stable buyers will scoop up bargains. Struggling Americans will be locked out of the market entirely, forced to cling to unreliable vehicles or risk repossession. In short, the collapse won't just reshape the car market, it will widen the wealth gap. The used car apocalypse is not just an economic story, it's a social one. Where you live and what your financial standing is will determine whether you emerge a winner or another statistic. 3 million vehicles. That's the tidal wave about to crash into the American car market. For years, used cars defied gravity. Prices soared. Families paid mortgages on wheels. Dealers thrived. Banks financed. Manufacturers overproduced. But now, the tide has turned. Repos are flooding auctions. Lease returns are piling up. Rental fleets are dumping cars by the millions. Zombie cars are slipping into circulation. Banks are freezing credit. Consumers are trapped in negative equity. Manufacturers are choking on oversupply. Every part of the automotive ecosystem is under strain. And yet, in every crisis lies opportunity. For many Americans, this collapse will be devastating. Jason, the welder who lost $13,000 on his truck, represents millions who will watch their hard-earned money evaporate. Families already stretched thin will face impossible choices: keep making crushing car payments or walk away. Dealers will close, banks will tighten, communities will lose jobs and revenue, but others, those who understand the cycle and prepare, will seize this moment. Mark, the construction worker who saved $9,000 by buying at the right time, shows what's possible. Prime borrowers, cash buyers, and the patient will walk into dealerships in 2026 and find deals unseen in decades. Luxury SUVs that once cost six figures will sell for half. Reliable sedans will be scooped up for pennies on the dollar. The question is, which side will you be on? This isn't just about cars, it's about a transfer of wealth. When markets collapse, money doesn't disappear. It moves. From the uninformed to the informed. From the desperate to the prepared. From those who bought at the peak to those who waited for the bottom. Industry insiders point to late 2025 through early 2026 as the sweet spot, the moment when the market bottoms out. Wait too long and you'll miss the bargains. Move too early and you'll catch a falling knife. The used car apocalypse is already here. The only question that matters is whether you'll be crushed by it or use it to your advantage. So ask yourself, are you Jason watching your vehicle's value collapse before your eyes? Or are you Mark walking into a dealership at the perfect moment and walking out thousands richer? The clock is ticking. The flood is coming. And 3 million vehicles won't wait. Once again, thanks for watching this video. If you got something out of this, hit that like button and make sure you're subscribed so you don't miss the next one. And hey, let me know your thoughts in the comments. Agree, disagree, or something in between. I'd love to hear it.